Lots to talk about what is going on this afternoon at 11 o'clock a.m. Pacific and 11:30 a.m. Pacific, 2 and 2:30 Eastern. We will talk about that first, and then we have a lot of important things that went on this morning that we must dive into as well. Again, the Fed meeting today really will have three components. The first, as I've said repeatedly, I am 99.999% sure we will get a 25 basis point move in the Fed funds rate. That is up, not down. No cut coming, in my opinion. That is the least important aspect of today's meeting. Number two, we will get the dot plot. Think of the dot plot as the collective wisdom of 19 Fed presidents looking into their broken crystal ball. And I want to be very, very clear. Their crystal ball is just as broken as yours and mine. So take all of their opinions with a grain of salt. Frankly, if you look at the historical dot plots, they have been horrible prognosticators. That said, it is very interesting to look at because you get insight into who is a hawk and who is a dove. Where we are going, it is once again very, very important to understand who is a hawk and who is a dove. Who wants to raise rates to the moon, who wants to stop. That is critically important. For the last 12 months, they have basically been preaching the same story. No more. The dot plot is important. And then third, I expect the Q&A session, which will start at 11:30. I don't know that I necessarily expect fireworks, but I expect Jerome Powell to be uncomfortable. I expect the media to beat him up with the same question said 17 different ways. I expect Jerome Powell might at some point get so frustrated that he says something market moving. The Q&A will be very important. But alas, all of that is this afternoon. We will, of course, be talking about it tomorrow morning. If it is so market moving, I may do a quick live stream in the afternoon with my thoughts. But let's watch it. Let's digest it. If it is so important, I may do a 2 or 3 minute live just getting my thoughts out there. But you can count on it. Tomorrow we will be talking about it in depth. All right, what is going on? Well, Jeremy Grantham. Jeremy Grantham is one of those white hairs, if you will, investors. He's been around since the early 80s, right? As you've heard me talk about, I think we are in a crisis similar to the late 70s or 80s. I've been sharing that with you for the better part of 2 years. I think it is rolling that direction. So listening to folks that have been around since then, you should at least hear them out. Well, this is what Jeremy Grantham has to say if you are a stock market investor. If you are a stock market investor, Jeremy Grantham is talking about the best case. I want to stress, his best case is S&P 500 giving earnings reductions and collapse in multiples will revisit 3,000. 3,000. Now, you know, if you watch our Millionaire Expert on Sunday, if we hit 3,000, the secular bull market is dead. We then enter a secular bear market. That is a very important number. But Jeremy Grantham is not done. Jeremy Grantham said in the worst case of a significant hard landing and credit contraction on steroids, the S&P 500 might hit 2,000. Now, lots of you hearing me say that is not possible. Let me remind you of something you and I have talked about for 2 years. I constantly remind you of this. During the dot-com crisis, the NASDAQ, the tech sector, the Cathie Wood sector dropped 82%. So don't you dare tell me it is not possible. I have lived through it and I lost 80% of my wealth. I lost 80% when the NASDAQ went down 82%. So I know with great certainty it is possible. So open your mind, Review what Jeremy has to say. You do not have to take it as gospel. I don't take anything as gospel. I just add it in and collectively move forward. But I thought that was interesting. More importantly, instead of picking an index amount, this is what I liked that Jeremy said, because it gives you something to watch. That is important to me. All these people picking numbers and doing this, if they don't share their ideas or their framework, it's useless to me. But this is what Jeremy says, and I think you can watch this because he gives dates and actions. Jeremy says, starting in May. Folks, May is like 6 weeks away, so this is like close. Starting in May, rising unemployment. We can watch that. We talk about it every Thursday. Slower growth. We can watch that. We have the Atlanta Fed tracker, which is updated daily. Oh, by the way, the Atlanta Fed tracker says GDP for Q1 is at 3.2%. That does not feel like a recession to me. Again, I believe the consumer cracked. It will be very different in Q2, but we shall see. And again, slimmer profit margins. Basically, Jeremy's theme is profit is coming down, margins are coming down. You take that on top of a lower multiple, bingo bango, you get 3,000 to 2,000. So again, do yourself a favor, check out Jeremy Grantham, see what he has to say. Again, Q1 GDP tracker for the Atlanta Fed. It's called GDP Now. You can Google it. GDP Now. As of March 16th, was 3.2% for Q1, while the experts are under 1%. Next up, Ali Wolf. Ali Wolf is a wonderful follow on Twitter. Folks, if you're not following me on Twitter, I need your help. You can follow me at one rental at a time. One of the things that I am doing on Twitter is I am poking, prodding the Crash Bros. And Reventure Consulting is one of those very active Twitter posters. I don't know what you call it. He's very active on Twitter, and he has some very creative ways of looking at the information. So do me a favor, follow me on Twitter, one rental at a time. Give me some support, because right now the Crash Bros are dominating me and I need some help. And if I'm wrong, of course, always take feedback, but it is Twitter is full of angry and hateful people. Yeah, there's almost no positivity on Twitter, so let's try to change that a little bit. But back to Ali Wolf. She does a report for Zonda about new home builders. She is talking about new home builders. She's the chief economist at Zonda. Transactions are up 2.2%. We're going to get a new number tomorrow. Zonda covers about 70% of new home builders. We will, of course, get the new home report tomorrow, Thursday. But by her report, transactions are up 2.2% month on month to 626,000. It is down, seasonally adjusted, 18.6% year on year. However, to me, this is wild. I don't know about you, but I am not shocked given where interest rates were last February and where interest rates are today, that transactions are down 18.6%. But check this out. Seriously, ask yourself if you would believe these numbers. Transactions as of February 2023, they are up 9.3% from 2019. 2019, pre-pandemic, decent economy. We are up 9%. As I have said repeatedly, the Crash Bros are wrong again. They are trying to spin people up that new home builders are going to go bust and out of business. It is not happening. These folks cannot read a cash flow statement. They don't understand an income statement. The builders are slowing down. They are managing their build. They're optioning land. But folks, we'll see tomorrow. Actually, no, today, after hours, KB Homes. What is KB Homes likely to report in my wild ass guess? Cancellation rate down. Profit margins maybe down 1%. Still profitable, still delivering units. They're not going anywhere. Next, One of the things I loved about Ali Wolf and her Zonda report is she breaks it down in 3 segments. Why are 3 segments important? It's because what you and I talk about. We talk about entry level, move up, and luxury. Ali Wolf's report calls it entry level, move up, and high end. Close enough for government work. She breaks it down even further. Price. Everybody wants price. All these crash bros want home builders to crash. They don't understand basic economics. According to Ali Wolf, chief economist at Zonda, entry level up 7% to $336,000. I would argue we need to do better. I think the entry level home, it will require a smaller footprint, needs to be sub 300, but I'm not a home builder. Next, move up. Move up comes in at 527 grand, up 7.1%. And then what she calls high end, what you and I call luxury, is up to 909 grand, up 7.8%. So do yourself a favor, follow Ali Wolf. That is Ali with an I, not a Y. If you do follow Ali Wolf on Twitter, do me a favor, tell her you heard about her from One Rental at a Time. I would love someday to interview Ali and talk about the economy and all things. And if you tell her you came from One Rental at a Time, she might respond to my message and we can have some fun talking about housing and the economy. So help me out. Tell Ali you came from One Rental at a Time. Next, Danielle DiMartino Booth. Danielle DiMartino Booth is out of the Texas area. She used to work at the Dallas Fed. She is someone I follow. All of these people up here, I want to be very, very clear. I don't always agree. I don't always agree. I want that to be clear. I am not somebody sitting in an echo chamber having all my buddies feed my ego. I follow people like Danielle, like Ali, like Jeremy, because they disagree with me and they back it up. They allow me the opportunity to question myself and get better. Danielle DiMartino Booth is one of those people I don't always agree with, but she backs it up. She causes me to evaluate my assumptions. Danielle DiMartino Booth, with the permission of her clients, published an article on Twitter that I have forwarded on my channel as must read, or my page, or whatever you call that thing. Follow me on Twitter, see it. Actually, I will try to go get the link and put it in the description in the next couple of hours. But folks, this is basically, where are we in this banking crisis? How did we get here? How big is it? What are the challenges? And where are the problems? It is an amazing read. It probably took me 15 or 20 minutes to get through it. Lots of graphs, lots of pictures. I really kind of dug in, and I think she did an amazing job of talking where we are at and where some cracks might be. So again, follow Danielle DiMartino Booth, follow her on Twitter. Please let her know you came from One Rental at a Time. I would love to interview Danielle because she is a wealth of knowledge and experience, and we don't always agree. I love that juxtaposition. Next, Signature. So again, lots of people talk Silicon Valley Bank. Again, remember Signature Bank went out on Sunday. Remember it was picked up, I think, by New York Bank Corp subsidiary. But as I said yesterday, I think there was about $60 billion in loans left behind. They were bad loans, according to the acquirer. According to Real Deal, again, a site that I follow, Real Deal, most of that $60 billion is in New York affordable rent-controlled housing. Said it another way, those loans are on buildings that were overpaid, that can't raise income while expenses are rising. Said another way, the buyers overpaid, the loans are shit. There is a lot of pain coming in the commercial multifamily market. Signature Loan is just the first to clearly point that out. Yeah, these are rent-stabilized apartments. Again, what does that mean in plain English? Income frozen expenses up, NOI down, value crushed, loans bad. So there was a critical video published yesterday by the one and only and amazing Beth Traverso. Beth Traverso is one of our millionaires that come back every week. She's a top 1% national producer. She is the bomb. She was gracious enough over the last week to go do some homework. She went and collected information across 6 critical categories about her market of King County, think Seattle, Washington. Chart number 6 is the visual I have been looking for. If you have followed my predictions from early January, I told you that I believed we would have 4 months of negative year-on-year numbers. Now, I am confident in that prediction because I have been looking every day. But that chart number 6, you have to watch that video if you want to skip ahead to the chart 6. It is amazing. Let me just tease you with this. Guess. Just guess. I'll actually hide the number. Just guess what the average purchase price to list price ratio was in Seattle in February of 2022. What does that mean? Let's just say the average list price was 500 grand. What do you think the average sold price was? I'll give you a hint. It was something greater than 500 grand. And again, this is average. This is not one-off. This is not, hey, that's that cute property with water views that was in a bidding war. This is the average transaction in Seattle for the month of February 2022. Folks, the average transactions, all transactions put in one box divided by number of transactions, the average purchase price was 112% of list price. I want to stand here right now and tell you I have never seen that. Think about that. The Seattle market in February of 2022 did thousands of transactions. To put all of those transactions, divide by the number and see 112% of list price, that tells you how crazy and bubblicious and problematic February 22, March of 22 is. And that is why we will see 4 months. We have to pay for that stupidity. That is stupid. I have seen averages 102, 103. I have never seen 112. That is why I told you in early January, I thought we would have 4 months. I didn't know if it would start in February or start in March. In February, we got our first negative year-on-year of negative 0.2%. We will get a negative in March. We will likely get a negative in April. And then, I don't know about May. If we do, that, in my opinion, will be the last one as we reverse out. It's wild. I am sitting here today after having a conversation with Beth, watching the video again, and I still can't believe that the entire market of Seattle, all the transactions, the average purchase price to list price was 112%. There is no wonder that the Seattle market is down 15% or whatever it is. It never should have been. It's just, that's not normal. But I digress. Go watch the video. It is amazing. Now, let's have a economics 101 discussion. The first thing you learn in economics, most people would likely take macro, then you take micro, is something called supply and demand, right? You got the supply, right? The higher the prices go, supply goes up, right? Then demand goes this way because the higher the prices, less people can afford it. I believe what we learned yesterday with the existing home sales is tantamount to what I have been highlighting but can't articulate. I believe the supply-demand curve for housing is broken and no one sees it. This is what I mean. Let's talk about demand first. So you and I know November, December, January, mortgage applications down, purchase applications down. Why? Rates were going up. What happened in late January, early February? Rates came down, momentarily touching 5.99. What happened? You were hearing it daily on this channel. Demand is up. Demand is up. Now we have validation. Demand went up 14.5% month on month. We went from 4 million to 4.5 million transactions annualized. So without question, cannot be argued. We now know demand increases as rates get closer to 6%. Cannot be argued. Can't. You can argue it, but you're a fool. When rates go down, it pulls the marginal buyer off the sidelines. I am not talking going to the moon, any of that nonsense. I am just saying, as the cost of capital gets closer to 6, we have the marginal buyer not only willing, but able. Remember, folks, as I've shared many times, demand is a two-step function. You have to be willing and you have to be able. The closer we get to 6%, the more willing and able buyers come out. Fact? Got it? Good? We now know demand goes up. However, and this is a big however that nobody is talking about. You and I have had this discussion. In fact, you and I have had conversations. I told you, or I asked you, what happens? Or I'm sorry, I said, at what rate would you sell your home if you had a low mortgage? And the general answer is somewhere between 4 and 4.5%. I don't care if it's 4 or 4.5, that doesn't matter. What matters is it's not 6%. So think about what I just said. As rates go to 6%, we now unequivocally know demand goes up, and we know unequivocally supply doesn't move. So I ask you, what happens when demand goes up and supply doesn't? That is where we are in the spring selling market, and I believe the spring selling market is damaged for years to come. This wave of inventory is not coming. You have heard Logan from Housing Wire in their last report. Again, follow me on Twitter. I forwarded that or said, wow, I hope this is a blip. Folks, the housing market is broken. At 6%, it brings buyers but not supply. That is a problem. How does this get fixed? Well, builders will get a larger percentage because, again, they are the folks that can add supply incrementally. They have the ability to adjust rate buy downs, make sure the payment is okay, and get people into housing. So again, demand up, supply does not move, builders do better. So again, folks, it is March 26th. It is Fed Day. I am excited. I don't know about you, but first, we need to congratulate people because on this channel, we do the work. We celebrate success. We are not hate. We are not fear. We do the work. So let's congratulate Mark for getting your first deal. Congratulations on your golden ticket. Mike, congratulations for your next deal. And Ben, you actually get a twofer. You closed on your first deal, getting your golden ticket, and you got your second deal at the same time. So Ben, you're getting a twofer. Folks, you can get these cards too. Just close a deal. Let me know that one rental at a time helps. I will need your address because that's how the post office works. But anyways, folks, like, subscribe, comment. Please share this channel with others. We need more people. Getting on the property ladder helps. Getting great deal helps. We don't gamble. We don't buy alligators. We don't buy just to buy. We buy great deals. Folks, bye.